On April 10, 2021, Alibaba was fined $2.8 billion by the State Administration for Market Regulation, or SAMR, for anti-competitive practices on its e-commerce platform. In this video, we'll discuss why Alibaba was fined, what this means for Alibaba, and what potential implications this fine could have on Alibaba stock. A few months back, on December 24, 2020, the SAMR announced that it was launching an investigation probe into Alibaba's e-commerce practices. As a result, Alibaba stock fell over 13% in one day, its largest one-day drop on record, decreasing over $80 billion in market value. The investigation planned to look into anti-competitive behavior from Alibaba's e-commerce platform with a focus on the choose one of two business practice. This practice involves sellers having to exclusively sell on Alibaba's platform, and if sellers choose to open a store on a competitor's platform, they risk facing multiple consequences from Alibaba. Understanding choose one of two is important because it was this e-commerce practice that primarily led to the $2.8 billion fine. Between December 2020 and April 2021, the SAMR Investigation Task Force conducted on-site inspections of Alibaba, analyzing employee transcripts, internal group chat messages, emails, cooperation agreements signed with sellers, and a variety of other documents. According to the investigation, since 2015, Alibaba used the choose one of two practice in order to 1. Restrict the development of other competitive platforms, and 2. Maintain and consolidate its own market position. This practice goes against Article 17 of the anti-monopoly law by restricting sellers to only sell on Alibaba by using various consequences to enforce this practice. How does choose one of two benefit Alibaba? As detailed by the SAMR, when more sellers join Alibaba, this attracts more consumers, which in turn attracts more sellers, creating a positive feedback loop. In general, the higher the brand awareness and market share of a seller, the greater the contribution to the competitiveness of the online retail platform. In order to enhance its own competitiveness and weaken the market power of other online retail platforms, Alibaba requested that sellers not open any stores on other platforms. As a result, this strengthened Alibaba's e-commerce market positioning. Alibaba implemented the choose one of two practice in two main ways. The first was to directly tell sellers to not open stores on other competitive platforms. Since 2015, some sellers have signed cooperation agreements with Alibaba, which state that those sellers will not open a store on another platform. Because Alibaba has a leading market position in e-commerce, many sellers have a strong dependence on the services of Alibaba's online retail platform. As a result, requirements presented by Alibaba have a strong binding force. The second way Alibaba implemented choose one of two is by telling sellers to not participate in promotional activities on other platforms. For example, during major shopping promotion events such as Double 11 or 618, Alibaba required sellers to not participate in other competitors' promotions. As a consequence for sellers that didn't follow the requirements of choose one of two, the SAMR found that Alibaba engaged in three main types of practices, which included 1. Reducing support for promotions, 2. Preventing brands from participating in promotions, and 3. Reducing the search ranking results of the seller's products. During the investigation process, Alibaba proposed that signing the cooperation agreement was voluntary for sellers, with restrictive measures only taken where sellers failed to comply with the agreement. However, the SAMR stated that the majority of the cooperation agreements regarding choose one of two were not signed voluntarily by sellers. The investigation showed that sellers tend to open stores and sell goods on multiple platforms, which goes against the requirements of the cooperation agreement. However, despite never voluntarily signing an agreement, these sellers still faced consequences. Following its investigation, the SAMR issued two main administrative penalties. First, the SAMR ordered Alibaba to stop the choose one of two practice, stating that sellers on the platform shall not be restricted from operating or joining promotional activities on other platforms. Meanwhile, Alibaba is expected to submit a report on its correction of this practice within 15 days of the penalty decision announcement. Alibaba is also required to strengthen its internal control and compliance management, maintain self-examination, and submit compliance reports to the SAMR for 3 consecutive years. The second penalty is a fine of 4% on its domestic sales of around $69.5 billion in 2019, resulting in a total fine of about $2.8 billion. Following the listed penalty announcement by the SAMR, according to Alibaba's corporate website, Alibaba has stated that they accept the penalty with sincerity and will ensure their compliance with determination. How much does this fine impact Alibaba? In comparison to Alibaba's free cash flow and cash reserves, this fine isn't that impactful on Alibaba's financials. The $2.8 billion fine represents less than 10% of Alibaba's last 12 months free cash flow and only about 5% of Alibaba's net cash. As a result, Alibaba is in a strong financial position to deal with this fine. In addition, it's important to emphasize that Alibaba didn't face the maximum fine possible. Domestic antitrust law allows for a maximum fine of 10% of a company's sales from the previous year. As a result, the maximum 10% fine could have been about $6.9 billion. However, Alibaba was only fined about 4% of its revenue, which was about $2.8 billion. This fine in of itself is unlikely to have a material impact on Alibaba's long-term growth. As discussed in our more detailed Alibaba stock analysis video, this $2.8 billion fine on Alibaba could be a positive catalyst for the stock in the short term. This is because some of Alibaba's regulatory overhang and uncertainty is removed now that the fine amount is confirmed. However, Alibaba still faces significant regulatory hurdles regarding Ant Group, their fintech business, which is another major contributor to the regulatory overhang weighing down on Alibaba stock. If more definitive information is released about Ant Group, this could serve as another positive catalyst for Alibaba stock. In addition, we have yet to see how the ban of the choose one of two practice will impact Alibaba's competitive positioning in e-commerce. Subscribe to stay updated for more videos, leave a like, and comment down below what videos you'd like to see next.